bought with borrowed money, and huge lending industry has been built to service the financial requirements of home buyers. So, guys, the financing principles that you will learn as you grow in your real estate business. There's many different types of products: FHA, conventional, VA, FHA 2, 3K. So, learning how the products work and learning how the financing works will be a great tool that you could utilize to help your clients with making better decisions. We're not here to teach you how to become loan officers, but we do want you to have an understanding of what that looks like on the financing side. These are the learning objectives. So, mortgage law. We're going to talk about mortgage law and how it affects people, as far as them being able to actually get a mortgage, and we actually will find out who actually gives mortgages and who actually receives the mortgages, because there is a misconception based on what we've learned growing up. So, mortgage law. Mortgage is a voluntary lien, and so mortgage is a voluntary lien on real estate. And in your book, let me see if I could get you the chapter. So in your book, you will see a chart that will show you on page 185. So page 185. The chart will show you the different types of liens. Every time we talk about liens, we always talk about money. Okay, so on page 185, it will show you the different charts. So on 185, you should see that a mortgage is a voluntary lien on real estate. So lenders. When we talk about lenders, we find out that the lender is the mortgagee. One thing that we learned in class was that anytime we do an OR, we are giving. Anytime we do an EE, or we see an EE, it means we are receiving. And if I misspell, I apologize. So the borrower is the mortgagor and pledges the land to the lender, who is the mortgagee, as security for debt. Okay, so things to remember: OR equals borrower, and then EE equals lender in this situation. And you'll see me switching back and forth when we're reading things out loud. I'll cross out mortgagee, and then I'll follow it by lender. That way we get in the habit of understanding who is who, and we don't get confused when it comes out to the exam. With the mortgage law, we see that we have different types of theory states. Okay, so for the national exam, for the national part, okay, so for the national, we have different types of states. We have title theory state, and we have a lien theory state. So the mortgagor, which let's cross out, the borrower, gives legal title to the mortgagee. The mortgagee is the lender. gives legal title to the lender, and retains equitable title. Equitable title, as you guys remember, is future interest in a property. So when you guys buy a car in cash, you guys get a legal title, right? When you buy a car that is on payments, the bank holds the actual title, but you have the future interest. Once you're done paying it off, then it actually becomes yours, and that's when you take over the actual full 100% possession over the property. So in a lien theory state, so let's cross this out. Remember, this is the mortgagor or the borrower retains legal equitable title, and the mortgagee. So how does so the borrower retains both, and the lender has a lien on the property as security for the mortgage debt. Okay. In a intermediate theory state, which is in Illinois, we are considered a, let me do it like this, we are considered a hybrid. Okay, so we're considered a hybrid. Mortgage and deed of trust convey only qualified title to the lender as a security for the loan during the existence of the debt. Illinois is referred to as an intermediate theory state. So on the exam, when we look at the state portion of it and we get asked the question, we can clearly state that it's an intermediate theory state. Mortgage loan instruments. Promissory note is a borrower's promise to repay debt. Okay, that's huge. This is going to be a vocab, and it's a promise to repay debt. Promissory note is a promise to repay debt. A mortgage is a security instrument. It creates lien on the property, considered hypothecation. For those that are bilingual, you could remember a mortgage as a hipoteca. In Spanish, hipoteca means mortgage. In Illinois, a deed of trust is treated like a mortgage and is subject to the same rules, including foreclosure. So a deed of trust, which is a vocab word, you guys could put this in your notes, equals mortgage. And one thing we'll remember is a mortgage has two parties, and a deed of trust has three parties, and we'll find out who they are shortly. A promissory note, let me do it this way. So a promissory note is the primary evidence of debt. So remember that as well. A promissory note is the promise to repay back debt, and a promissory note is the primary evidence of debt. Interest, a charge for using money. We all know that there is no free money in this world. Okay, there is no free money in this world. So the way we get charged to use money is something called interest. Usury. So usury, charging interest on a loan in excess of the maximum legal allowable rate. But in Illinois, there is currently no state limit on the real estate of the interest that a lender may charge a borrower when the loan is secured by real estate. So in Illinois, essentially, there is no usury. In Illinois, or let's do it this way, not in Illinois. Loan origination fee. A loan origination fee is charged by who? The lender. Okay, so us as realtors, we don't charge a loan origination fee. But loan origination fee charged to cover the expenses involved in generating the loan. Discount points. Discount points are used to make up the difference between the interest rate and the lender charges the borrower and the rate of return demanded by investor. The lender charges the borrower discount points. One discount point equals 1% of the loan amount and is paid as prepaid interest at closing. Guys, the biggest thing to remember here, in, just specifically for the exam, is that one point equals 0.01 or 1%. Okay? So one discount point equals 0.01 for mathematical purposes or 1%. Provision of the note. So provision of the note. We have a sometimes there's something called prepayment penalties. A prepayment penalty is for a penalty for paying off the loan early. But in Illinois, lenders are prohibited from charging a borrower a prepayment penalty on any loan secured by the residential real estate when the loan interest rate is greater than 8% per year. Other thing to remember is that a note equals a negotiable instrument. A note equals a negotiable instrument. All right, so let's go back to mortgages. So remember I said a mortgage has two parties, okay? When the money is borrowed, this is how it works. So the mortgagor equals the borrower, mortgagee equals the lender. I always cross them out so that you guys have a full understanding and get in the habit of remembering who is who. That way you guys don't get confused. So look at what we see here. The mortgagor or the borrower is the one that gives a note and the mortgage to who? The lender. What does the lender give back when they receive a mortgage? They give back the money to purchase the property. Remember the misconception that lenders are the ones handing out mortgages. When the money is repaid, the mortgagor or the borrower, so they pay out the money, right? And now the lender has to give something called a satisfaction of mortgage, basically dictating that everything has been fully paid off, and now the person, there's no longer a loan on the property, and the person now has full control of the property. In a deed of trust is still like a mortgage, but it has three parties. So as you could see here, it's the same thing. So the trustor, which is the borrower, okay, trustor is the borrower, and the beneficiary is now the lender. The beneficiary is the lender. So the trustor gives a note, the beneficiary gives out the loan, and the trustor conveys. Remember, if we convey something, we're giving something. They convey the trust. They convey the deed of trust, and the trustee. So this is a third party, holds naked title. Trustee holds naked title. When the money is repaid, the trustor or the borrower pays the loan off. So, bam, the loan gets paid off. Now the trustee, they have to reconvey, so they have to give back. So they do a release of deed, or they do a deed of reconveyance. So a deed of reconveyance. Let's see. So duties of the mortgagor. Okay. So we have to make sure that the payment of the debt is in accordance with the terms of the note. Payment of all real estate taxes on the property is given as security, so we always have to pay taxes. Maintenance and of adequate insurance to protect the lender, so the property always has to be insured. Maintenance of the property in good repair at all times, so making sure that always happens. Lender authorization before making any major alterations on the property. I've never heard of a homeowner having to call the lender and say, hey, I'm redoing my kitchen, right? Sometimes they just do it, but per the exam, it's on the slide, so we teach it. Provisions for default. So we have something called acceleration clause, okay? So acceleration clause. Let's do this. So we have acceleration clause. The best way to remember acceleration clause is remember every time you put your foot on the pedal, right? So let's think of this as a little car, and every time you press your foot on the pedal, it makes it go faster, right? So acceleration clause, basically what that means is that the bank or the lender may ask for the whole debt to be paid immediately. So acceleration clause, if a borrower defaults on the acceleration clause, gives the lender the right to accelerate the maturity of the debt. So if they stop paying on something, or they're behind, or whatever it may be, the lender has the ability to activate the acceleration clause, demanding that everything must be paid immediately. Assignment of mortgage. So remember, the assignment of mortgage. Okay. A note may be sold to a third party. So assignment of mortgage. A note may be sold to a third party, such as an investor or another mortgage company. The assignee becomes the owner of the debt and the security instrument. So remember, when we assign something, we no longer have take responsibility of that. Okay. Release of mortgage. So release of mortgage lien. We'll have something called a defeasance clause. Defeasance clause. Sorry. Requires the mortgage to execute a satisfaction of mortgage when the note has been fully paid. So when the defeasance clause is when we defeat the mortgage. Okay. So let's do this. So we defeat the mortgage. Okay. When we defeat the mortgage, what are they going to give us? They're going to give us something called a satisfaction of mortgage. So when we defeat the mortgage, which is a defeasance clause, we will get something called a satisfaction of mortgage, which is the release of the mortgage lien. In Illinois, a mortgagee who fails to deliver a release within 1 month after a full payment and satisfaction will be liable to pay a mortgagor, which is the borrower, a $200 penalty. Okay. The release must state, for the protection of the owner, this release shall be filed with the record of the registrar of titles in whose office the mortgage or deed of trust was filed. It is the mortgagor, so it is the borrower's responsibility to record the release. Taxes and insurance. So in Illinois, the lender may require borrowers to provide reserve funds called an impound trust or an escrow account to meet future real estate taxes. So basically, the escrow account, let's say this is our little pot of gold, or their little bank account, right? So if this is the borrower, right, they're going to be putting money monthly in here so that the lender or the mortgage company, right, can take out so that they could pay the taxes for next year. So taxes and insurance for next year. Okay. So that's what an escrow account is. Flood insurance reserves. So if a property lies in a flood plain, right, they're going to need an extra insurance in order to cover it, just in case it floods or anything like that. Sometimes it could be extra 700, extra 1500, extra 2500, depending on what type of level of flood zone it's in. Okay, when we talk about PITI, so PITI, we talk about principal, interest, taxes, and insurance. So, provision of the mortgage, assignments of rents. The borrower may provide for rents to be assigned to the lender in the event of the borrower's default. So if someone stops paying it, maybe during this pandemic, they'll assign all the rents to the lender so that they keep up with all the payments. So we have our next vocabs: subject to the mortgage and assumption of the mortgage. So the buyer is responsible for making payments on the pre-existing debt, but is not personally liable upon default if the sale does not pay off the entire debt. The purchaser is not liable for the difference. Okay. Assumption of the mortgage. The buyer becomes personally obligated for the payment of the entire debt if the mortgage is foreclosed and the court sale does not bring enough money to pay the debt in full. A deficiency judgment may be obtained for the unpaid portion of it. So what we're going to end up doing here is, or what the lender will end up doing here, so if they sell it for 190 but the loan was for 200, they could sue for the extra 10K that was lost. Okay, so that's assumption of the mortgage. Alienation clause. Alienation clause is also called a resale clause, due on sale clause, call clause, transfer clause. Provides that when the property is sold, the lender may either declare the entire debt due immediately or permit the buyer to assume the loan at the current market interest rate. So it allows to dictate whether the loan gets paid off altogether, or if, like say in an instance of a VA, another veteran comes in and assumes the loan. Provision of the mortgage. Priority of a mortgage of deed of trust, recording a mortgage of deed of trust. Okay, so remember that in these cases, the deed of whether it's the mortgage or a deed of trust, they always have to be recorded. Okay, remember the whole line aspect of things. When the picture where people are in line, so first to record, first to get paid. Okay. So recording a mortgage of deed of trust, a mortgage document of deed of trust must be recorded in the recorder's office of the county in which the real estate is located. Priority of a mortgage deed of trust. Priority of mortgages and other liens normally is determined by the order in which they were recorded. So always try recording right away. And the banks will always try recording their liens first. Okay, installment land contracts. When we talk about installment land contracts, we're talking about seller financing. Okay, so we're not talking about land. Okay, so installment land contract, we're talking about seller financing. The buyer, which is the vendee, so make sure you guys put that in your note, and then seller, which is the vendor. Buyer vendee makes a down payment as a monthly loan payment that includes interest and principal directly to the seller. Seller, which is the vendor, retains legal title to the property during contract terms, and the buyer is granted equitable title and possession. Once the entire debt is paid, the seller delivers the title. Contract usually permits evictions in case of default. If buyer has 20% equity, judicial foreclosure would be necessary. Methods of foreclosure. So we have a non-judicial. So remember, judicial means court. Non-judicial means doesn't have to go to court. So non-judicial foreclosure, no court action is required. And then judicial foreclosure, the property is sold by court order. Okay. Strict foreclosure, court simply awards full legal title to the lender. Excuse me. So the deed in lieu of foreclosure. So a lender may accept a deed in lieu of foreclosure from the borrower, sometimes known as a friendly foreclosure. So deed in lieu of foreclosure, someone is literally just giving up the keys to the bank and saying, hey, please take it off my hands, basically. Okay. Redemption. Okay, so this might be a little bit tricky one. So you have the equitable right of redemption, which is before the foreclosure. And if it's after a foreclosure, you have something called a statutory right of redemption. So just think of it this way. So this is before, after, and this is the foreclosure right here. Okay. So if it's before, we have the equitable right of redemption. If it's after, we have statutory right of redemption. Remember, statutory meaning laws, courts, things of that nature. In Illinois, there is no statutory right of redemption. A mortgagor in default who wishes to exercise the equitable right of redemption to avoid loss of the mortgage real estate may do so after the date of judgment or of foreclosure is entered. When a property is redeemed, the sale does not occur. Okay. So deficiency judgment. If the foreclosure sale does not produce enough cash to pay the loan balance in full, the mortgagee may be entitled to a personal judgment against the borrower for unpaid balances. So a deficiency judgment, so basically remember, they sell it for $190 and they had $200K left on the loan, and so they could sue for that $10K. Deficiency judgment. Short sales. Borrower is unable to make mortgage payments and cannot sell for what it's owed on the property. So short sales, the way this works is if they owe $210 but the house is only worth $180 in the market, then the bank will allow them to do a short sale, and the bank will then eat up whatever the rest was. Okay. The lender has to agree to accept less than the amount owed, and potential for several different types of frauds. Okay, so remember, as a realtor, we're not negotiating with the seller. We're going to be negotiating with the bank. Okay. What is the purpose of promissory note? A promise to repay and is primary evidence of debt. What is the purpose of a mortgage? It's so that someone could provide some type of collateral in case of a default. Who are the mortgagor and the mortgagee in real estate? Mortgagor is the borrower, mortgagee is the lender. Okay. And who are the trustor, trustee, and beneficiary? Trustee holds naked title. Beneficiary is the lender. Trustor is the borrower. Okay. Under the lien theory, the equitable title to the property is held by the mortgagee. False. Okay. Because remember, there's a lien on it. Land contract provides the sale of unimproved land only. False. Remember, we're not talking about land. We're talking about seller financing. The clause in the deed of trust or mortgage that permits the lender to declare the entire unpaid balance immediately due and payable upon default is the acceleration clause. True. The defeasance clause in the mortgage requires that mortgagee to execute a satisfaction of mortgage. True. Remember, we defeat the mortgage. When we defeat the mortgage, we get something called a satisfaction of mortgage. These are your vocab. So you could pause here. Here's some more. Remember novation. Think of the shredder. Here's the old contract. When it comes out the shredder, we get a new contract, novation. There's no usury in Illinois, and there's no prepayment penalty in Illinois. So you guys could pause here as well.